Good morning, everyone. Thank you for joining us in this webinar organized by ithoughtpms for Sphere, where we are going to be talking about beating market volatility with multi-asset investing. So, this is an interesting topic because we need to understand what is our market context today, how is it going to change in the next year, and how can we as investors actually prepare for this scenario. So before we begin, I'd just like to thank everyone for joining us. We welcome you to participate. Feel free to type in any questions that you have in the chat box or in the Q&A section. I'll be answering all the questions towards the end of the webinar. I'd like to keep this as interactive as possible so that we can get the most out of today's session. And if you have any questions about Sphere, you can always get in touch with our team, and I'll be posting our contact details at the end of the webinar. But our number on WhatsApp is 9500027285. So you can drop a message and we'll be able to assist you with whatever it is that you want to do going forward. So without further ado, I'd like to start on how we can actually beat market volatility with multi-asset investing. So the first way that we can look at volatility and actually measure it is through something known as the VIX or the volatility index. So this is a chart of India's volatility index or India VIX. And if we see that the average has basically been around 14.1, right? And if we look at where volatility in May and June, primarily because there was a lot of uncertainty around the elections and how the election result would actually affect markets. So if you look at the VIX numbers at that point, it crossed 2025 levels, whereas before that, the average was around 11, or 13 maybe. That is prior to the election. So this 1 month you had a spike in volatility. The next spike happens around the budget. Again, here a lot of uncertainty in how the policies would be implemented. There was a change in terms of short-term and long-term capital gains. So all of that, if you look at August, that is late July, August, you see another big spike. Definitely not as big as a spike around the election period, but definitely much higher level of volatility than we've been used to. Then if we move to the third segment of this table where you're trending above the average, it's actually been in the last 1.5 months, which is say from your late September till recently, right? So your end of like in September, we've had a peak in the market. So the Nifty hit a new all-time high. And from there till almost the end of November, that is November, you've had the markets consistently fall. And this was at the back of very heavy FII selling and a shift in sentiment because of how the US elections played out. And also coupling with that, you had our domestic Q2 earnings come out. You had your GDP data being released. So all of this has actually contributed to a change in perspectives and a divergence in how India as an economy will be in 2025. So if we look at data as to how our economy has been performing, there's been a slowdown, say from March, April this year in the economic data. You're seeing that in commentary that's coming in from companies. And if you'd like to know more about what companies are saying and corporate India is talking about, there is a webinar that we're organizing just for clients after this at 12 p.m. So that is something as an investor you should definitely attend if there are any clients on this call. Corporate India also shows us that, okay, there is a slowdown in terms of earnings. There are some revisions that are happening in terms of earnings expectations. But what we've by and large seen is that there hasn't really been too much of a change in valuation. So after this spike in volatility that we've seen in November, the markets actually recovered a little bit towards the last week of November. And since then, especially in the last 1 week, you've actually had the overall levels of volatility come down. Yesterday, of course, being an expert, had heavy selling in the morning and heavy buying which means that as investors, we should actually be prepared for more volatility. And to prepare for more volatility, one way is to always have liquidity. The other way is to actually follow a multi-asset approach, because having assets outside of equities actually insulate you from what is happening in the equity market. It also gives you the opportunity to re-enter whenever you want, depending on what kind of assets you're to touch upon before we get into the technical aspects of why multi-asset investing actually is a solution to volatile markets, is that behavior is also very different in volatile markets. So on one hand, we have investors who feel that, okay, markets were down for a while in November, but now they've already moved up. I'll just wait for the next correction before I invest. Anyway, it's going to be volatile, right? So why should I put my money in today when there's a chance that it will go down in a bit? Then there's the other segment which says that, okay, I have enough proof. Already the markets are moving up. It came down. I didn't do anything. Moving up. Let me not wait anymore. I I want to put my money in before it's too late. Then you investors who've put in money and then they've had a very rough week, or in a very short time they see that and they feel that, you know what, I should have waited. Why did I have to rush and put my money in? If I had waited, then probably I would have caught the bottom and I wouldn't have to deal with this loss that is there in the portfolio. And then you have those who are sitting on the sidelines and watching what other people are doing, especially when they see that other people have already created wealth. Then they start wondering, have I actually missed the bus? Do I have a chance to re enter these markets at all? So, none of these investors are actually going to create wealth in a sustainable manner, suffering from some kind of behavioral issue or the other, right? So when you say that you want to wait until the market reaches a particular level, or you want to wait until the market corrects, you're actually encouraging a investment discipline, right? And this means that you are not going to be consistent with SIPs. It means that you're not going to participate when the market corrects, because you're going to wait for a lower level. And markets are very unpredictable. Even if you say that, okay, when the Nifty touches X level, I will put in more money, it doesn't really work that way, right? Because what if you don't reach that level at all? What if you reach a different level? So all of these are important sort of questions that we need to ask about where we can bring in discipline in an area where there's a lot of scope to be undisciplined and emotional. Um, and then if you're the kind of person who sees performance and then makes an investment, then you're actually encouraging a behavior where you're chasing performance. And whenever you're chasing performance, it's ideally also a momentum play. And when you're chasing momentum, you can get caught on the wrong side of that trade. So that's a huge risk that an investor is taking. And usually, the fact of the matter is nothing keeps performing forever, right? Everything performs in cycles. And if you're going to own companies that are performing cyclically, or stocks that are actually performing cyclically, and if you catch them after a period of performance, either there's very little runway left for you to create wealth, or you're heading into a very turbulent zone where you stand to lose more than you gain. So it's important not to chase performance, but to anticipate it and prepare for it, and be patient when you're building that performance, right? So if you feel that, okay, if you're the kind of person who's checking your portfolio every day or every week to see if it's up, down, if it's at the right level, then I think there is an inherent problem, because that information actually causes us to react to it. So if I see that my portfolio is down, then I feel like I must be doing something about it, right? And if I go on seeing that, okay, I opened my portfolio on Monday, it was down. I opened my portfolio on Tuesday, it was still down. On Wednesday, it was worse. And if you go on doing this, then what tends to happen is that at some point you feel like it's not enough to just know what's happening in your portfolio. You have to do something about it. And typically, when we react from an emotional space, as far as money is concerned, our reactions tend to be counterproductive to wealth creation. So, we basically need to find a way to pause and not be so anxious in our investing. We need to think a productive and healthy way of our portfolios. So when we see that performance is down, we can try to understand what is dragging down performance. Is it something that we really need to worry about? Is it something that we can ignore because this is just how the market behaves? Or is there some action that you can take to improve your portfolio? When we start asking these questions, when we start thinking from a more analytical perspective and not from an emotional perspective, we are inclined to make better wealth creation decisions. So, and coming to the last person in this room, we do understand that yes, there is that sentiment of FOMO, right? That when you see other portfolios are performing really well, but yours is not doing so well, or that you've been sitting on the sidelines, not really doing anything for some time, then you start to worry that, okay, have I actually missed the bus? But the bus is not other people's returns. It's not how much money you could have made. The bus is actually your milestone. So we need to have a certain level of discipline in terms of where we want to take our wealth. And there are very simple and effective ways to do this. If you are a young investor without too much clarity as to what the shape of your life is going to be, then you need to set concrete milestones. So you can say that I want to be at 50 lakhs in year X, or when I'm so old, and then I want to be at 1 crore, 2 crores, 5 crores, 10 crores, whatever your ultimate goal is, right? So we need to set those milestones and say that, okay, in this year, I want to ideally be here. And there are two ways to achieve that goal. One is obviously to think about how compounding works. And if I have a goal that's 5 years away, there's some amount of heavy lifting that will get done through compounding. But the second thing is also to understand that your contributions matter a lot. And that means each year you need to have a target as to how much you're going to save, how much you're going to scale up. So if I'm saving, say, 30% of my income in year one, then probably in year two, I might want to take that to 35 or 40%, right? And then slowly sort of build that from there so that I'm able to achieve those milestones earlier. Now, if you're someone who's older, then your responsibilities are far more concrete and you know what all you have to provide for, you know how you need to plan for the future. And then these targets are already set in stone for you. So if you're looking at retirement, then it's very easy to calculate how much money you would actually need to retire. And it makes a lot of sense for you to get a financial plan to set all of your goals and your priorities in order. Many times we have these things in our mind as a list, but when you put pen to paper, there's a lot more clarity that emerges and there's a lot more prioritization that you can do, which makes your investments more productive. So the milestones are actually more important than the measurement of returns that we tend to focus on. So we tend to look at, okay, what is the index doing? What is so and so's portfolio doing? How much money did they make? How did this fund do? I decided not to open a PMS there. I opened it here instead. And when we do this comparing, right, across products and people benchmarks, then we kind of actually miss the bigger picture, which is why are we saving in the first place? Right? There are things that you want to do with that money. And unless we become clear about what it is that we want to do with that money, we can't really make it very productive. So this brings us to the result of doing these things, which is this is a great quote from Ray Dalio, who's the founder of Bridgewater. And he says that the most important thing that an investor can actually have is a strategic asset allocation mix, right? Which means that you have a portfolio that is balanced, that is structured, and that can perform in different environments. It's not enough to have a portfolio that does really well for 2 or 3 years and then goes into a slump and you can't bear that as an investor, right? Many of us don't have the capacity to deal with prolonged periods of underperformance. And the thing is, you don't know what these different environments are going to be, which is why diversification is so important. So, when we have the milestones in place, we need a strategic asset allocation mix. And when we have the strategic asset allocation mix, we are positioned to win in different environments. And when we are able to win in different environments, those milestones and financial goals that we were talking about, it becomes much, much easier to actually achieve them. So coming to Okay, we threw a couple of big words there. What exactly is this strategic asset allocation that we're talking about, right? It doesn't make sense if I'm just going to use terminology. So, when we look at what strategic asset allocation is, you have to spend some time in reflecting as to what is the best investment that you've made, right? What do you think is the best investment that you've made? And investment. So when you ask people this question, what often comes out as the best investment is the one that's done the best, right? The one that has given the best returns, because we're very happy with the outcome and the rewards that we've reaped from that particular strategy. But what often gets missed is the things that have stood by our side during the toughest times. So if you ask an investor, typically the answer would be, oh, this fund in my portfolio has given me the best returns, and this is what I think is the best uh, investment that I've made, and I should have done more in that. But what they miss out, and especially if someone has been in the markets for more than 5 years, is that they would have forgotten that during COVID, they had a lot of FDs which actually stood by their side. They had a lot of investments that were stable when the market corrected 20%. Right. So, the best investment is not always the one that gives you the best returns. It's the one that allows you to make more choices. Right. And then that brings us to the question of, is there such a thing as a bad investment? But those very investors who had fixed income allocations prior to COVID and then realized that, oh, during this really tough phase in the market, debt did really well. And then they started FDs or even put money into target maturity funds or mutual funds. They realized that, okay, like, my returns, I was expecting like a 7-8% return, and now I'm getting a 3 to 5% return. So this seems like a horrible investment. So the thing is, we need to ask whether there is such a thing as a bad investment. And then the next thing that we need to sort of spend time on understanding is, does performance actually follow a pattern? That is, can I say, you know, equity works in 3 year cycles, debt works in 5 year cycles. So then every 5 years, I need to change my fixed income allocation, and every 3 years, I need to change my equity allocation. Is there a particular pattern, or can I say things like, okay, when equity does well, then fixed income doesn't do well, so I should choose between these two at any point in time? Or are there these kind of patterns that you can identify in asset classes and then structure a portfolio according to that? And the last question is, uh, can we actually predict returns, right? And as a fun exercise, what I would suggest for everyone is, you just put the performance that you think the Nifty will do in December, right? We are halfway through the month, so you have a good sense of what has happened in the market so far, and you're only looking at another 2 weeks of performance that you need to kind of predict, right? So you put down a number. Do you think the Nifty will be up 1%, down 1%? Where do you think, or if you want to look at the level itself, look at today's Nifty level and see where you think it's going to be at the end of the month. Just write this down on your phone, set a reminder for 31st December, and go back and check it at that point and see how you fared, right? Because uh, nobody can actually predict returns, no matter how often you try to do it, no matter what kind of data and models you have. It's very difficult to do this, primarily because there are so many moving parts, right? So, for example, if we think about this year itself, the kind of year that 2024 has been, so many countries went into elections. If we look at what the polls were saying about India's election outcome versus the actual results that came in, huge difference, right? And we can say the same, like we've had a more like a bigger election outcome that happened in November with the US elections. And if we look at all of the commentary, right, like across the board, across different political strategists, they were all saying that this outcome is going to be very difficult to predict because the margins are so narrow. But what was the outcome and what was the margin, right? We all know that the outcome was very different from the predictions. And these are all people who have the statistics, who've done the groundwork. And we tend to be wrong. So if you can be wrong about politics, I think you can definitely be wrong about markets as well as the economy. So The key here is that we need to think about what actually makes a good investment. We need to think about whether performance can be predicted, whether there is like a pattern or a trend that we can look out for, which will help us choose this right mix of assets. So now I'll bring you to a very interesting data point that we love sharing at Sphere. This is the Mint Quilt. So Live Mint publishes a quilt every year with how assets have actually performed across the board. So we've got say, from 2010 to 2023, and next month you'll probably have 2024 data as well, and it'll be interesting to see which actually comes out on top and what's at the bottom. So broadly, like what this teaches us is that no, there isn't really a pattern per se. Because let's say if we look at gold, which is the orange box across, you see some years it's right on top, some years it's bottom, some years it's positive, some years it's negative. Few years in between it's stuck roughly in the middle. If we look at, let's say, small cap, which is your gray boxes everywhere, you see the same thing. There's no fixed pattern, right? It's not 1 year up, 1 year down. You have a few years where it's completely at the bottom. So if you see 2018, 19, small cap was right at the bottom. 2017, right at the top. 2016, right at the bottom, right? And then you see 2020, 2021, right at the top again, right? So there is no clear pattern, right? There is nothing that's fixed or set in stone. And if we take any two assets together, also, you don't actually notice any trends, right? So, what is clear is that winners can become losers. We've seen that with gold, we've seen that with small cap. Anything else that's at the top of the charts, you can see that that holds true. We see that losers can also become winners. Again, same data points. If you look at it, you will see the same thing across the board. You know that there are some stable performers. So if you say, if you look at any of the fixed income categories, that is credit risk, corporate bond, or in, let's say, your large caps, they broadly tend to be a little bit more predictable. Of course, you do have deeper cycles of segments where you get completely negative returns. And that is something we need to be careful about. But ideally, I think there is some level of stability when we look at these kind of asset classes. So, moving on, let's kind of investors who have expanded their risk appetites in this market cycle. And what do we mean by that? Investment, right? So investment, right? So can 3 year small cap returns actually be negative? And I'm going to put out a poll in the chat, and you can sort of respond to that. Just give me 1 second to add that in. Okay, so a lot of votes for yes. 3 year small cap returns. Yes, chances are there. Some responses for no. I see that there are around 30 people in this room. So until we get a few more people to vote in, I would like to wait. Okay. So we have a rarely. Just going to give it 1 or 2 more minutes before uh, we move on from this slide. Okay, so I think by and large, a lot of yes, few people have voted for no, and fewer people have voted for maybe, right? That is rarely you can have negative returns in small caps. So let's actually take a look at the data. We've done a very basic thing using the live mint quilt that I had shown you earlier, which is what does that data actually look like, right? So the 1 year returns are what you saw in the previous chart. So you had in 2010, for example, the small cap market was up 17%, and in 2011 it was down uh, 35 36%, right? So if we look at 3 year data, that is, if I take the returns, assuming I invested in 2010 and I wanted to check my portfolio value in 2012, then my net return was 1.25%. So that's actually not the kind of return expectations that a small cap investor has. Uh, there is a certain expectation that okay, it's going to be different and it's going to be much higher, right? You're looking at doubling your money. That's the kind of return expectation that you have. And just for these are all absolute returns. These are not compounded. So please adjust for that when you're making these kind of decisions. So if you see your 3 year performance, there are roughly, I think, three in the last 14 years where your returns are below expectations, that is like near zero or below zero, right? Then there are 3 year periods where your total return is say like 10, 11%. And then of course you have the phases where you've so important thing being that when you start and how performance is in between actually makes a huge difference. So for example, even though 2022 was a bad, it turned out to be pretty good because you started off with a really good number, meaning you were at you had a good year in 2020, you had an even better year in 2021, and then you had a disappointing year in 2022. So there are chances for 3 year returns. And of course, I've taken small cap as an example today, but we ran the same data with gold a few months back, and we can do it with any asset class, right? And we'll see that this is true of any asset class. It doesn't have to be about this is not a take on small caps. You can still do really well in small cap investing. And if you're interested in seeing how that's possible, you can look being that whatever asset, there is no right or wrong asset, there is no good or bad asset, there is nothing that is not going to create wealth for you. And there are things that have been very reliable in the past, which will become others as well. So that is the basic message that we have here. Because let's say you started investing in 2013 in a year where small caps actually lost money by 10%, right? Your years, which is pretty phenomenal. Given that you lost 10% of your portfolio. So I think it's important to keep in mind that all of this is just temporary. We need to have longer timelines. We need to be able to understand what is happening at a cyclic level, and we need to know that bad assets. There are just assets, and they at times will work, and at times, and there are ways to assess why, right? So this broad philosophy is actually sort of condensed very nicely by Howard Marks, where he says that there's no such thing as a good idea or a bad idea in the investment world. It's a good idea at a price and it's a bad idea at a price, right? Meaning at specific price points or valuations, something is a screaming buy and something is a screaming sell. And when we are able to assess that valuation, we are able to either make returns, or we're able to explain, right, why it's possible to make returns or why it's not possible to make returns with a particular asset at a particular valuation. So the idea with multi-asset investing is that you want to be at the right place at the right time. And our three big takeaways from that chart that we looked at from Live Mint is that, first of all, there are no years where all assets fail, which is the most important takeaway, right? As a moderately a conservative investor but ambitious investor, you don't want to be stuck in an investment class which is going to bring you periodic failures, because that kind of lowers your confidence and your ability to scale up at the most important times. The second thing is, if we look at how multi-asset investing works, right? I said you're conservative, but you're also ambitious. So when you're ambitious, you don't want to miss out on things. And if we look at the number of years in which all assets have delivered positive returns, half the time that's true, which means you're not in. So there's a misconception that if you take a more multi-asset approach to investing, you're not going to make equity-like return, right? That if I had invested, so you'll see all of these statistics. If you had invested in the BSE Sensex in 1991, then today what would be the wealth that you had, right? What all could you have owned in that time frame if you had just stuck around? But the point is, it's not that you're transported in time, right? It's not like you're given a portfolio in 1990 and then you arrive happily in 2025 to see that your portfolio has done so well for you. What tends to happen is that we actually experience each year on year, and there are years where you have very rough years in the market, and that's what kind of makes us move in and move out of these asset classes. But when you have a mixed portfolio, when you have that strategic asset allocation that's calibrated correctly, then half of the time it's not that you're investing in losing asset classes, right? There, all your assets are delivering positive returns, which is not at all a bad solution. And then we come to the third lesson, which is something that I had mentioned when we were looking at the chart itself, which is that losers can become winners and winners can become losers. So never discount or label asset classes as good or bad. You never know where the next big opportunity is actually going to come from. So let's talk about how portfolios can actually do well in different environments. So if we look at what each asset brings to the table, we'll see that domestic equities actually help us with wealth creation, because India, despite the latest Q2 numbers and the commentary that's going on in terms of where our growth is heading, we are still poised to be the fastest growing economy in the world. And as far as this slowdown is concerned, there are both cyclical and structural elements to it. And you are seeing some level of structural influence coming in from, say, fiscal and monetary policy to bring growth back on track. And that is something that we need to focus on. And given that India is going to be one of the fastest growing economies or the largest growth engines in the world, then we need to be participating in our own markets. Foreign equities, on the other hand, will bring in that geographic diversification. And actually, if we look at how the world operated during COVID, pretty much all economies went into contraction mode. They went into, in terms of economic activity, they went into very loose fiscal and monetary policy. But when we came out of COVID, actually different countries ended up taking different paths, and that is playing out obviously in a very interesting manner, which means there is a lot of scope for you to look outside of Indian markets and outside of Indian opportunities to create wealth as well. And when we look at fixed income, right, as an asset class, your short-term debt actually gives you a lot of portfolio stability. So we talked about the VIX and how we're anticipating a more volatile year in 2025. And when we look at that data, we actually understand that an asset class like fixed income can provide that much needed stability and flexibility within a portfolio. But when you look at long-term debt, it's not the same thing as short-term debt, because long-term debt has an additional risk reward built into it, which is in terms of mark-to-market gains, right? Short-term debt is more predictable because if you buy a bond and you know it's going to mature in 3 years, the set of cash flows is very well defined. But when you look at longer-term bonds, the cash flow, in addition to the cash flow component, you also have this demand supply dynamic that's there, which could push your price of the bond up or down, enhancing or reducing your returns. So, long-term debt actually, in a cyclical manner, can add some real value to your table, to your portfolio. And then when you come to precious metals and commodities, right, there's a lot of interesting elements that they bring to the table, mostly in terms of how they're able to combat inflation, how they're able to be less correlated to your direct equity markets and your fixed income markets. So this is broadly why you need a mix of assets and how to sort of look at your strategic asset allocation in terms of how much of your assets are exposed to each of these asset classes and what the right time to invest in each of these asset classes is. So now we'll come to the mathematics behind how you're able to beat market volatility, and it's actually fairly simple, right? In mathematics, there's this concept known as correlation, which means that if I have one variable X and I have another variable Y, when X moves up, what happens to Y? And is there a pattern to this, right? So when X moves up and Y also moves up, then you see that they have a positive correlation. If also when X moves down, then Y also moves down, right? So that means whatever X does, Y imitates it in some manner or magnitude. So so depending on how much this imitation or mimicry happens, then you say assets are more or less correlated with each other, right? So if, let's say, every time X moves up, Y also moves up and in the same magnitude, then they tend to have a correlation, a positive correlation of 1. But let's say the opposite happens, right? When X moves up, Y behaves the opposite. It actually moves down. Then you tend to say that they have a negative correlation. So, these are basically charts that explain positive correlation, high positive correlation, low positive correlation, and no relation. So when you plot all of these data points and you get a straight upward facing line, then you tend to have a perfect positive correlation, and that is of 1. Similarly, if you plot the same line and you're looking at the last graph, then you see that it has a perfect negative correlation, right? But if you're somewhere in the middle, right, and you have all of these data points and you're not able to see how they interact with each other, then you have no correlation. So the basic idea of portfolio construction is you want to add assets that have different levels of correlation with each other, because that is when you can actually perform in different environments and in a wider range of scenarios, because things are not all going together. Otherwise, let's say I have only large cap funds in my portfolio or only blue chip stocks in my portfolio, or only small cap stocks in my portfolio. And see, in that case, at least they're spread across industries. So there is a chance that while one company may not be doing well, another company can do well. But let's say I'm within the same narrow theme, right? Let's say all my companies are pharma stocks. Then what tends to happen is if there is some event that affects the industry, then the entire portfolio is going to be affected by that regulation, whether it's positive. So then you're exposed to a very narrow set of risks, and there are very few ways in which it can play out. Whereas if I add some other layer to that, then I'm automatically preparing for alternate scenarios as well. So this is data that's come out from Bandhan Mutual Fund in terms of how these correlations rank. So obviously any asset, its correlation with itself is going to be one because perfect, right? It's not going to behave in two different ways. We are dealing with a very set world. But let's say if you look at the Nifty 50 versus the MSCI ACWI, which is basically your global index, that has a correlation of point as well. And what's an even better fit actually turns out to be gold because gold has a negative correlation, which means that it actually performs in a very different environment and scenario than equities. And debt, your correlation with uh, equities is very low, it's 0.05. Your correlation with gold is slightly better at 0.22, and your correlation with the world is slightly even better than that at 0.28, right? So this diversity in a portfolio, this is what we mean by. It's a great quote from Peter Bernstein where he says that, diversification isn't about survival. It isn't about survival. It's actually an aggressive strategy because you don't know what the next winner is. Like nobody, if you think so, as an exercise, we can all put down what we think 2024's best performing asset class is going to be, right? And we have the data in front of us. It's not that you can't go and look up the returns that the Nifty delivered or the small cap index delivered or gold or real estate did this year. You can actually look that up. But will it hold true for the next 2 weeks? We don't know that, right? And we can see that what you think, what you assume is today's winner versus one wide difference between these three predictions. So if we think about what investors are actually worried about today, I think the number one worry is inflation because that's been front and center of every RBI policy meeting. And we've also seen that the inflation print was at 6.2 and then it's come down in the latest reading. But clearly, we're in a phase where weather is very unpredictable, and while your CPI basket may be unpredictable, and while your CPI basket may be coming down, the real inflation is in vegetables, right? And take a hit, even if it's not showing up in your CPI numbers. So that is something hit, even if it's not showing up in your CPI numbers. So that is something that we're all worried about. We're also fairly concerned about war, right? There's been a lot of updates on unrest across the world. So you have government settlement, you really don't know how this is going to pan out. The same organizations that Western economies were sort of battling against are the ones who are going to come into power. You have still unresolved conflicts in Europe as well as the Middle East. So these are things that are not going to, that we can't do away with easily. No easy answers to these kind of questions. There is still some level of fear around a recession, especially in the US. Trump's victory has, to some extent, sort of eased those fears. But if we look at some indicators, if we look at what's happening on the economic front, as well as the things that have come out of the election, and in terms of what kind of policies are coming to the table, definitely inflation is still a worry. Recessions, if they're cyclical, you cannot avoid them. Monetary policy can only manage the cyclicality of economic contraction. Is that markets have been continuously rising in India, even with FII outflows, even with a lot of the other things that are happening. You've seen the market kind of move in one direction, right? And finally, like I think the whole point of today's conversation was to talk about market volatility and how that's become a more imminent risk in today's context. So, if you're worried about these things, then the basic idea is that you need to turn your fears into opportunities. You need to turn your concerns into opportunities. I think while at a broad level you're seeing markets move up, I think on the domestic equity side, we are still at a relatively higher growth number. We still have wider participation opportunities. You do have things where an investor can look at in terms of valuations. It's not that the whole market is at the same level. There are selective pockets that you can participate in. Specifically, if you're looking at higher quality investments, the blue chips have relatively more attractive valuations than their small and mid counterparts. Within the small cap space, investing outside of the index also makes sense. So even for aggressive investors today, there are a lot of interesting opportunities. There are high value opportunities. That you can look at. When you look at short term debt, your yields are actually pretty high today. On the longer term debt side, maybe you need to time your entry point and you need to think about your investment horizon a little bit in more detail. Primarily because we've been at the peak of the interest rate cycle for a while, right? The RBI has not hiked interest rates for a long time. It doesn't look like they're going to hike interest rates, and we've had a change in committee as well as a change of governor that's kicking in. So all of these things would make us think about whether this is the right entry point from a cyclical perspective, but from a structural perspective, obviously we've seen macros improve. There's a lot more demand for Indian government bonds in the global market. All of that is happening, right? Given all of the concerns on geopolitics, war, all of this, I think you do have uh, this theme of precious metals that are going to perform quite well. And finally, we have to think about reflation, that is your inflation, not. So we've brought it down to a certain level, but is it going to come back? Are we dealing with a new normal? These are things that we have to think about. And I think in that scenario, commodities could also play a good role in portfolio stability. So I'd like to quickly walk you through what's happening with Sphere, our multi-asset product, and this is where the magic happens. So we are able to make asset allocations work for investors like you because we're very conscious of valuations. We stay away from the crowd. We follow a contrarian approach to investing, which means the things that we do in the portfolio are unusual and ahead of the curve. We also believe in a much more patient and gentle way of investing, which means that we believe that good things will come to those who wait. And we genuinely believe in the power of asset allocation as a wealth creator because we've seen how a little bit of everything can actually work wonders for the investor. Multi-asset investing also works because it means more investors can enjoy the benefits of this product, meaning it suits a wider range of risk profiles. It definitely will exceed the moderate investors' return expectations. And it also is something that allows investors to participate continuously because investment opportunities keep changing, right? So just to show you our performance numbers, so the maroon rust line is Sphere. Our last 1 month returns have been slightly low at about -2-ish%. But if you look at every other timeline, right? So if we look at 3 months, we have outperformed the multi-asset category. We've outperformed the multi-asset index. We've outperformed the Nifty. So pretty much any benchmark that we've set beyond the 3 month, 6 month, 1 year, since inception timelines, Sphere has done exceedingly well, and we're quite confident of performing in a wider range of markets. And if we look at how Sphere handles drawdowns, then we are somewhere between the multi-asset index, which is say only about 50% in equities, and we're well below 100% equity product like the Nifty. And this is our performance as of last month. So we have about 65% in equities, a good exposure to both precious metals and global investments, and some towards cash and fixed income. right? So our 1 month performance, like I said, is minus 0.2%, but you can clearly see the outperformance in every other timeline against the multi-asset index. And in the previous chart, you would have seen all the other benchmarks that we've set. So just a quick look at the key terms of investment. We are a SEBI registered PMS, which means that by SEBI regulations, the minimum investment is 50 lakhs. We run a fixed fee product, which means there's no profit sharing. So whatever excess returns we make is actually left for the investor to enjoy. And ideally, multi-asset investing works in a cycle of 5 to 10 years. So anybody who's coming in would see those benefits if they stay for, say, 5 to 7 years. And we have a very flexible mandate allowing us to take positions in any of these asset classes based on what is the best asset class at a given point in time. So a quick overview of the team at ithoughtpms. So this is across all of our products. We have 4 PMS products: Solitaire, True Blue, Riddhi, and Sphere. And this is the team. There are a lot of people who are working to make this happen. And with that, I will open up for questions. I think I already see a couple of things in the chat box. So let me start taking those right away. And anyone else who has anything, please feel free to type this in. We can take questions. Okay. This is the contact number. So 9500027285. And I think Gopi has also left us something on the chat box where you can just drop us a message on WhatsApp. Okay, so does Sphere invest in commodities? So if you're talking about directly in commodities, no. And we don't do any derivatives, so then that is also not possible. But there are other routes, like let's say through the ETFs and mutual funds, that can allow us exposure to those themes. And that is how we do take it. Okay, I will look at the questions in the Q&A as well. Okay, if PMS coupon ticket size itself is minimum 50 lakhs, then how come most common ordinary retail investors who are also doing mostly MFSIP can invest huge amount bulk lump sum? Okay, so the basic question here is that an organization run many programs for investors, and we do not differentiate between investors 50 lakhs and you can participate in a PMS product. Then you're most welcome to choose one of the PMS products that we have on offer. If you're a smaller investor, we have a program called Milestones to Wealth. And the idea is not to grow you in mutual funds and bring you into PMS. The idea is to help you get to that target of 1 day. And this is a long-term journey, right? So for someone who's able to save, say, 5 or 10,000 rupees today per month, it's not possible for them to look at, say, a PMS in like 5 years, right? So it's a long-term journey that we're partnering with small investors. So if you want to look at a program like that where you can grow to 1 crore, not necessarily with the end goal of coming into PMS, just with the end goal of creating that kind of wealth, it is possible. And Gopi can share more details on that. Also, is it not risky to invest the entire bulk lump sum of 50 lakhs at one go in equities when markets are in peak? How does Sphere mitigate investors as capital protection is key, right? So yes, we never believe in putting in all of the money on day one. Many fund houses, that is on the PMS side, tend to follow a model portfolio on day one. That's not the model that we follow. We're very conscious of valuations, like I said. So we like to participate in ideas when they are in a zone that is comfortable, where we feel the risk and the reward are well balanced. So typically when an investor starts their portfolio in Sphere, on day one, it doesn't get fully deployed. It can take about 2 to 3 months for that portfolio to be fully deployed. And investors are encouraged to participate and treat this as a savings vehicle. We are not one of those typical PMSs where you can just invest and forget. We do believe in wealth creation, and wealth creation means that we want to participate continuously. We want to take advantage of the opportunities that the market has for us. And this is how we protect investors. And uh, even as you rightly pointed out, the idea behind Sphere is we don't want to put all of the money directly into the equity markets. There is money that goes into other asset classes as well on day one. And deployment changes over time based on how conducive different asset classes are. Okay, so the difference between Sphere and Sphere Neo is pretty simple. Basic is Sphere Neo is catering only to NRIs, and here caters to resident individuals. That's the basic differentiation. The fundamental strategy and the ideas are quite similar across both because we follow a value contrarian philosophy across all PMSs. Both of them have a multi-asset mandate. So for somebody who's a non-resident Indian and who wants to participate in Indian markets but also wants a flavor of multi-asset investing, then Neo is more suitable for them. For somebody who's a resident Indian, then we feel this is a better choice. Recently, SEBI informed for small investors to start from 10 lakh to 1 crore like PMS is it launched. So this is on the mutual fund side. And no, I think it's not yet launched. Like they've not released those products yet. Oh, thank you, sir. Thank you for appreciating the work that we put in. We really do like to talk to investors every week. We like to participate and have a good session. So happy to answer any more questions that anybody may have. Sir, I know you had asked for our number. I hope you've been able to message us on WhatsApp. If not, uh, we can definitely get in touch with you after the webinar. And anything that you want to discuss, we can have a one-on-one call as well. This is an interesting question, but I think it's been all over the papers this morning. So if you look at the FII, DII data, you would have noticed that there was a lot of FII buying that happened. So possibly that could be one reason because there was heavy selling in the morning and then buying in the afternoon. I would think this is my interpretation. Yes, definitely. If you're working with our team, then you can probably disclose what your assets are to some extent. Then we can help you identify how much more, if there is any scope for you to do more in gold, or if you need to focus more on equity, they can definitely help you in deciding your asset allocation as well. And there are many ways that you can do that. You don't have to come only through the PMS route. You can also come through the mutual fund side. Okay, interesting question. How to choose between solitaire and sphere? You don't have to choose between both of them. You can actually choose both of them. We don't like to do this either or. Ideally, I think for an investor to start off with, uh, maybe one of the PMSs will make more sense than the others, right? Uh, and that is based on the kind of investments that you want to have, the kind of risk appetite that you have, the investment style that you would prefer. So based on that, we can actually help you identify which would be the best fit. Uh, and over time, as you're able to save more, you can add a second or even a third PMS. A lot of our clients have overlaps across the product. So there are some clients who own Sphere and True Blue. There are some clients who own Sphere and Solitaire. There are some clients who do others as well, like meaning solitaire and vriddhi. So all of the combinations actually work. And yeah, of course, we are looking at minimum 1 crore wealth creation in milestones to wealth. So I don't see why anyone else in this room should not have that as a target. Okay. So I see that we're a few minutes, or we've overshot a few minutes from our time, and I'll just give it 1 or 2 minutes to take any last questions. But a big thank you to everyone who's come today and who's put in a question and engaged in conversation with us. Thank you. We are committed to investor education, and Learning Saturdays has been our initiative to make sure that we're able to communicate something about markets, investments, and wealth creation with you. Okay, if I already have a portfolio around 25 lakhs in stocks and mutual funds, uh, we can actually, if you enroll in Milestones to Wealth or with iThought MFD, then definitely your mutual fund portfolio can be reviewed by our team, and that is something that we can work with you on. Sir, I think you're misunderstanding the statement. The question was, why do I have to choose between both? And the investor's intent is that they feel that both products are good. So it's not that I'm suggesting that they need to put in 1 crore. It's just that we can work towards that target and the investor can own both assets. Can stability be ensured in equity alone? I think if you have equity plus cash, right? I mean, that is a certain level of asset allocation that happens in the other PMS products because they actively take cash calls. Then I think you can have a little bit more stability, but the most important thing is that you need to balance that trade-off in the sense, see, like if we look at 2023, the first 3 months of the year, markets were doing very badly. There was a lot of volatility. There was a lot of drawdowns that were happening. And the expectation was that 2023 would be a bad year for equities. But if you saw the calendar year returns for equities, they were phenomenal, right? So there's always that tricky balance of, if you sit in cash and you don't participate, the market can go up and a lot more than you think that it will go up, right? At the same time, if you don't take any cash calls, you can get stuck on the wrong side of that. So you can't ensure stability alone, even with the equity cash balance, unless you compromise on returns to a large extent. So you have to be willing to take some level of drawdown if you want to this thing. Uh, just a second. I think if you would like to get your portfolio reviewed, then you would need to message our M2W team and enroll in M2W or with iThought MFT, and then I think the portfolio review can also be done. Or you can just simply drop us a message on WhatsApp. I'm just typing in the number here for your reference, and we can discuss next steps on a one-on-one basis in terms of what you actually need. All right. So I think see, that's true. It's not that you can't manage a pure equity portfolio, but what I'm trying to tell you is that returns will not always be positive. There are always investment opportunities, but even in certain markets, see, when you have a broader market correction, that is regardless of whether your sector is undervalued, fairly valued, you will see a drawdown. It's not possible for you to have positive returns in every time period with a pure equity portfolio. That's the only point that I'm making. But yes, from an investment perspective, you don't need multi-asset investing if that is your goal, right? You can manage investing, you can find opportunities in one or the other sector or one or the other market cap space at any point in time. It's that is definitely possible. All right. So with that, I'll just end our meeting. Thank you once again, everybody. And if you have more questions, please do feel to free to write to us. I've dropped our WhatsApp number on the chat, and I think Gopi has also done that a little earlier. So he sent a message with this. So any services that you're interested in, you can just send a message on this WhatsApp now. All right. Thank you and have a great weekend.